when the crisis started, the world lost, we think now, about 14 million barrels per day, which is about 13% of its of global oil supply. And if you calculate what the oil price should be getting to, it's much higher than anything we saw during the crisis.
What is the sort of ballpark dollar figure that our viewers should expect the oil price to go to equilibrate supply and demand? Like, what are we looking at now?
Well, I should say this is not a forecast, but I love a rule of thumb, and I've looked up the rules of thumb based on the estimated price increases you would need to destroy 13% of demand for oil. And the numbers you get from the literature are a range of $167 to $460. Now, I'm not predicting anything like that, but it shows you that we are in a totally crazy world. The oil price sort of fluctuated with hopes and fears about an end to the war and President Trump's truth social posts and that sort of thing. So what traders were really thinking is, we don't think this crisis is going to last a long time. There's going to be a deal, point one. Point two, we think that deal is going to reopen the strait and reopen it in a meaningful, permanent way. And point three, that once that happens, things will get back to normal quite quickly and the oil price will come back down. But basically what's been going on over the last few days is that view has begun to collapse. There is no peace deal, so the first leg's going down. And I think the whole lot is up for debate now.
Traders, your friends, Mathieu, the people you know well, either have been assuming the war will end quickly, the strait will be open quickly, and then we'll get supply back to normal. And we, on our cover this week, I'm afraid, decided that they were in la-la land. But I think all of your conclusion is that oil prices are still not yet high enough to balance supply and demand as you laid out. So, Mathieu, do you think these oil traders are now seriously nervous, or will we go back to the more sanguine view we had just a few weeks ago?
I still think they are, to an extent, in la-la land, because you can take two yardsticks to judge that. One is to look at the past, look back at what happened after the Russian invasion of Ukraine, where the fear was that we would lose about 3 million barrels a day of oil because Western countries stopped buying it. We did not lose that. In the end, it went to China and India. But that still pushed the price of oil to near $130 a barrel. And today we're well short of that, even though the deficit is real and it's much, much larger, like 4 to 5 times that. So that's one. And the second one is to look at how this deficit is being absorbed at the moment. And it's mostly being absorbed by dwindling stocks, so perhaps 8 to 10 million barrels a day at the moment, if you count government stocks and other types of stocks, commercial stocks. That's far too fast. It's a record space. We've never seen that, which shows you that prices are not high enough to destroy demand. So when I speak to traders that actually trade the physical stuff, they move barrels all around the world, they agree with this analysis. They think the price has to rise much higher.
Henry, one of the reasons prices haven't shot up as much as we had expected them to, and one would expect, given the scale of supply that's locked inside the strait, is that production elsewhere has gone up. Do you want to talk us through how much that has helped the situation, and can it continue?
Well, production elsewhere has gone up a bit, but most of the additional production in the world that can be brought online is in the Middle East, so is also trapped. You can get a bit from the US. You can get a bit from loosening sanctions on Russia. It's a totally different scale to the lost production. So it's really chalk and cheese here. So that can't rescue the world from the situation.
So you've had a bit from extra production, and you've had a lot, Mathieu, from stocks, both commercially held stocks and official reserves, and stocks at sea, effectively. What's happening? Can you talk us through all of those? Because part of the fact that we're all getting on planes and everything is still running is because of that supply that was kind of sitting out there and is being drawn down.
Yeah, the biggest buffer really has been the oil that was already at sea when the war started and Hormuz closed. And that was a result of a couple of things. One is that Middle Eastern countries, the Gulf countries, they heard the drums of war before it happened. They saw the American warships converge on the region. They saw the tensions rise. And so they cranked up exports before the war started. All these tankers were already past the straits when the first strikes happened. So that's one. There was a lot of that already at sea. And then secondly, sanctions before the war, Western sanctions were tightened on Russia and Iran, which pushed Chinese buyers, Indian buyers to shun the tankers that carry these barrels usually. So you had this excess of Russian, Iranian crude and products at sea. And add all this together, and it was quite a big volume.
What's happened to that? Has that been drawn down completely?
It's been drawn down very significantly, really fast. I mean, if you look at specific product like jet fuel, we are far below historical averages. It's the same for diesel. And we're pretty close to the minimum level you need to just sustain trade at sea. You need a certain number of barrels for the transit to be possible. And then for crude, you've got a bit more. But also, you need to make longer voyages these days to link the US to China, for example, because the Gulf is no longer a source. So even that is not that reassuring.
So what happens then? You're reaching stock levels that are well below, or minimal, and you have demand that is much higher than the sort of sustainable amount of supply. So presumably prices have to absolutely shoot up to reduce the demand as much as is necessary.
Yes, exactly. I mean, there's basically two levels left. One is demand destruction. The second one is stocks, commercial stocks dwindling. And what you're seeing now is mostly commercial stock taking the brunt of it, with some level of demand destruction in Asia. And that means that commercial stocks will fall quite fast.